That being said, I'm going to navigate over to the PowerOptions suite of tools, and I'm going to use that platform, of course, to answer our questions in the visual format. I'm sorry, let me just make sure here that we've got what we're, there we go. Okay, so we're looking right now at the PowerOptions screen. This, of course, is the setup that you'd see on a 14-day free trial. And the 14-day free trial here, if you're currently on the trial, I'm sorry, and you haven't yet, make sure you take advantage of these 4 steps to get more familiar with the tools on the site and the various strategies as well. Okay. All right, so Sheldon asks, is there some form of Excel spreadsheet that can show me the consequences of each of a $1 movement on a spread? Okay, well, not right now. It's something that's interesting, Sheldon, as see our portfolio tools will be able to track the positions, whether you're tracking spread positions, straddles or strangles, any multiple strategies here. Here's a basic one. Let's go to another portfolio. That's probably expired already, but that's okay. Let's just go here for UBNT. So to organize it by the different structures, and I might have multiple bull put spreads or multiple covered calls. But what this tool is not showing you, of course, it doesn't have an ability in our portfolio tools to show you how each position would change if there was a 1-point movement in the underlying for each one. Let's see if I can get the programmers to work on that actually. If I'm trading multiple credit spreads, that'd be a very useful tool. But what I can do is if I found a tool on the search, or if I found a tool, let's say on, I found a spread on the search, or I enter one in my portfolio. Let me just go to the search for bull put credits right now, for example. Okay, see the weekly bull put screen there. And let's just take Bristol-Myers Squibb. It's 14 days away, so it expires on July 14th. Small spread, 54 to 53. But let's go ahead and look at the profit and loss chart on PowerOptions, of course. And this gives you a breakdown. Oh, sorry about that. I was working fine earlier, but what we can do here down at the bottom, of course, is you can run what-if scenarios on the position. Oh, I'm sorry, there we go. Okay, so down here below, there we go. Down here below on the profit and loss chart, the stock was at 55.72, so if I thought the stock was going to go up to 56.72, I can just go ahead and hit calculate, and you see down here, I apologize, Sheldon. There we go. You see down here, we could expect to see the differences in our gain on a selected date. So if I changed it now, what would happen if the stock moved to 56.72 on July 3rd? Well, I might have a profit of $6. And then if it moved another dollar, I could keep changing that and keep adjusting that as well. But right now, I don't think the portfolio has a position. The portfolio doesn't have a way where I can view the 10 or 15, let's say, spreads or positions I'm tracking and see how each would change if there was a 1-point change in the stock price. Okay, so I'm going to get with the programmer, Sheldon, and we're going to talk about that. I'm going to see if I can get something in to evaluate what the portfolio would look like for a 1-point movement on each underlying security or a multi-point movement on each one of the underlying securities as well. Okay, so there we go. Another second question here came from Tom. Where can I find info on managing spreads? All right. Well, at any time, Tom, you can go here underneath the main home tab and go to free webinars. And on the free webinars page, we have a variety of archived presentations on the PowerOptions tools, using the search, setting up the portfolio, creating a personal stock list, and more. And there's a variety of presentations on options strategies. Okay, so there's calendar spread basics and criteria, managing covered call positions. Here's a full webinar on managing bear call spreads. But if you're more interested in bull put spreads, if you go further down, here's a whole presentation on managing your bull put credit spreads. And if you're doing debit spreads as well, there is a full webinar on just managing your spread positions also. Okay, so there's a variety of different webinars you can view, whether you're into bearish spreads, whether you're into bullish spreads, credits or debits, underneath the option strategies. Let me just send you a link very quickly. It's powerop.com/webinars.asp. This page we're viewing here is a public page. You don't need to be logged on, Tom, to view it. You can just go ahead at any time. But you can just go directly to this page. And you might also see, if you go to the requested topics, here are the recordings of our Friday presentation. And here's one on outcomes of bull spreads, but it doesn't really talk about the management. There's one we did recently. I'm just going through here, but you can go through the different information. Covered call setup, reverse collars. Credit spread trading plan. This is from March 24th, 2017. Credit spread trading plan, success rate, management, and protection. Okay, so this is also a webinar you'd want to check out where we sort of go through the different management techniques in more of a shorter view as well. Okay, all right, so let's go ahead now and take a look at some of our other questions. Paul asks, if I subscribe to Fusion, that's a service we offer at RadioActive Trading, which is focusing on the limited risk trading technique of the married puts and the 12 different income methods. But he says, does that replace my current subscription or would it be in addition? And right now, Paul, it is in addition. The RadioActive Trading website and the subscription to Fusion is in addition to the PowerOptions subscription. Okay, and what do you get with the Fusion subscription? It's about $69 per month. But if you picked up the blueprints recently, you may be able to get your first month of Fusion for only $10. Okay, and what is available at Fusion? Well, Fusion subscribers will have access to a series of lessons. There's about 70 lessons that Kurt, myself, and Ernie put together to sort of help emphasize the ideas in the blueprint and the concepts of the radioactive trading techniques. The open trade/trade tracker, that allows you to see what current radioactive trades are currently open in my portfolio. These are my real trades and Ernie's portfolio as well. So you can follow along with us as we apply this in our actual portfolios. The RPM report, Paul, is very similar to the search that you have on PowerOptions right now under married puts, the radioactive default screen. It's the same criteria, but you just can't adjust parameters. But 90% of the positions that we open for the open trades and trade tracker for Fusion subscribers come directly from that list. The stock insurance tool, which you also have available in PowerOptions, but then there's a series of archived webinars and white papers for members only as well. So that's what you get with the Fusion. You get to follow our trades, access to the lessons, the search basic RPM report, and the members-only white papers, as well as the stock insurance tool, which you already have on PowerOptions as well. But unfortunately, it is a separate service, so it would be an additional cost as well. Okay, Betty asked a question, but then she gave me the information. Betty says she owns 300 shares of USO, and 300 shares of USO. And she says she bought 9.50 calls for July 21. Okay, and she's saying it shows a delta of 496. 496, what does that mean? Okay, exactly. I don't know what that means either. Okay. Betty, in order for me to tell you what you can or cannot do with your 300 shares of USO, I'd need a price. I don't know if you're in the water, in the money, if you're underwater on that position. I'm not really sure. Okay, so let's go back to PowerOptions. And let's just take a look here. USO is currently trading at right at 950. Okay, so we've got USO is right at 950. And you say you have 300 shares, but you also have the 950 calls for July. All right, you bought it at 876. Okay, I'm going to show you something in a minute. Fantastic. So you bought that at 876 was your cost basis on the shares of USO. All right. So first, let's take a look at this. When I have a gain in an underlying security, a couple of things that I'll do first is I might go to the married put menu, which relates to the radioactive trading techniques. I'm going to go to insurance. Okay. What this tool allows me to do is it allows me to see what puts I could buy against the position that I have an unrealized gain in. So let's use USO, and you have a cost basis of 876. And to start off, I'm going to leave it at all expirations. Okay, so let's go ahead and hit calculate. Now we know here we have an unrealized gain of 74 cents or 8.4% on the position. Going shorter term, we're shown that right now, if I bought the July 1050 put for 103, and it looks a little expensive, but if you bought the July 1050 puts 21 days out for 103, you'd have a new cost basis of 979. But you're guaranteed to get 1050 back, so you'd have a locked-in profit, a guaranteed return of 7.3%, no matter what USO does next. Okay, so this is essentially what we call a bulletproof trade. All right, there we go. And what it would look like here, here's the profit and loss chart I was trying to show earlier, but you have 876 into the stock. You would pay 103 for this short-term July put, so no matter what the stock does, you're guaranteed to get 1050 back, so you've locked in 7.3. And if the stock does happen to go up to 1060, 1070, or 1080 by July 21st, you could realize more profit. If it drops down to 850, below where you purchased it, or 750, doesn't matter. You've locked yourself into a guaranteed profit of $71. Okay, now that's a short-term put, obviously. I don't know if that's your trading plan for this stock. If you're planning on staying in USO longer, let's say maybe 4 months or 5 months, well, you'd want to go further out in time. Now, we could go out to January, but because that put is going to have more time premium, we're not going to get as much guaranteed return, as much locked-in profit. So let's just take a look at the January series for USO. I'll go to January 2018. This is on the insurance tool. Okay. All right. Now, okay, Betty says she's new to options, zero experience. Perfect. I mean, this is what we sometimes call the, I'm going to show you an example of a product I'm going to have released soon, which we call the hat trick for longing and gains. And you also have the 950 call, and I'll talk about that in a moment. But you own 300 shares of stock at 876. You've got an unrealized gain of 8.4%. Okay, let's talk about that. We've got a stock here. I don't need to put up a real graph or anything here, Betty. But you've got a stock currently trading at 950. Oops, sorry folks, you've got a cost basis of 876. So there's our 74 cents unrealized profit. Now, if you set a stop at $9, okay, that can work for you. You could just set a stop on your stock, so you'd still have a profit of 24 cents, 25 cents or so. And the stop order tells your broker, hey, if the stock ever reaches 901, go ahead and sell to close the shares. The trend is reversed, it's pulled down, you're telling to get out of the position, okay? And along the way, you could sell premium against it, maybe sell a covered call or do something along those lines, depending on, again, your outlook for the stock going forward. But what happens on Monday if the stock gaps down to 888? Okay, it's not a big deal, but what would happen is this stop order at 901, Betty, just becomes a market order, meaning you told your broker to sell to close your shares of stock if it's ever trading below 901. Well, the market opens at 888. It's below 901. Your broker can't get you 901. He can only get you $8.88. That's the best he can do for your position at the current market price. You still have a profit of 12 cents on the position, and that might be okay. But what happens if something unexpected? And I know this is a huge ETF. It's not going to drop 2 or 3 points. But what happened if it gapped open to $7 on Monday's open because something disastrous happens in the oil ETF, in the conglomerates, or something happens with the UAE and the price gouging, whatever. Not likely, but let's say that it does, and it dropped down to 7. Your stop is just a market order that says close me out if it's ever below 9. You get filled at 7. Where you had an 8.4% return, you now have a $2 I'm sorry, a $1.76 loss off an investment of $8.76. That's why people get hurt with stops. Okay? When you buy a put option, you have purchased the right to force someone to buy your shares of stock from you at any time between now and the expiration date for $10, no matter what the stock does. You've got to pay a hefty premium, but there's something very interesting about this is what I like here. You have to pay a premium to do this, okay? But think about this. This is out to January on USO. This isn't as great as a bulletproof status as we saw before with the shorter term July option. And that's why I mentioned I don't know what your trading plan is for the stock itself, these 300 shares. If you're planning on holding them long term because you think USO might get up to the $12, $15, or $20 range, buying the put now, even though you're adding $1.15 into the cost basis to put your new cost basis at $9.91, but remember, you're guaranteed to get $10 back. So you have a guaranteed profit of 0.9% in the absolute worst case scenario between now and January expiration. But that doesn't mean that's the only thing you can do. Let's go ahead and go to the profit and loss chart. Here's your position. It changed the prices, so we're going to drop that back down to 115 for us. So we get that, there we go. So we get that 0.9% view. You still own 300 shares of stock at 876. I'm showing 101. Let me change it so you can see the full math there. So you own 300 shares of USO at 876 per share. You would go out, buy 3. You could, based on what your expectations are for the stock, how long you're planning on holding it. You could buy 3 January 10 strike puts, which give you the right to force someone to buy your shares of stock from you at $10 anytime between now and January expiration. You would force someone to buy your shares of stock. So you're going to pay $345, my apologies, out of your pocket to guarantee a 1% return. But that's the worst case scenario. If the stock moves up here from 950, let's say it goes to 1020 in the next 30 days, you don't lose 1-to-1 with the put. Okay, this is a delta here. The delta is probably around negative 0.55, meaning that even if the stock moves up $1, you're only going to lose 55 cents on the put. You're not losing 1-to-1. This 345 does not disappear. You still has value. Why is that important? Again, as we did before, let's say 20 days from now, July expiration, USO goes up to 1020. Okay, you paid $345 or $1.15 per contract for your puts, but they expire in January. They're going to retain most of their time value. So if the stock moves up to 1020, you'd have a gain now of an additional $432 on your stock for your price of $876, but your puts would only lose $111. You'd have a profit of $321 on an investment of $29.73, so you're above 10%. Even though this only locked you into a gain of 0.1%, as we're looking here forward, the put doesn't decay 1-to-1. It's going to retain most of its value. It's going to be worth about 85 cents if the stock moves up to 1020. And as it keeps going, you could actually maneuver this put from the 10 strike to the 11 strike and also guarantee this. But let's not talk about moving forward. What is this? This is a no-risk position. There's no way you can lose on USO now. Now, sure, the maximum, the worst-case scenario is only 0.1% or 0.9%. I apologize. I meant to say 1% roughly, but 0.9%. But again, the stock could go to $9, could go to $7. The ETF could go to $6. You're guaranteed a profit. Okay? And you still have unlimited upside. Okay? But one thing you've probably heard, Betty, is if you own a stock and it's moved up in price, you're going to want to reward yourself. And what do I mean by reward yourself? Well, you want to generate premium at a higher price to help lower the cost basis. So you bought a January put. That's fine. That insures you for, let's see, 130 days, 203 days. Okay, almost 7 months out in time. But I can say, but you know what? The stock's at 950. Ugh, 6 cents. Terrible, 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 terrible. But yeah, let's go further out. I'm just going to go to August 4th, okay, and so we could sell the 10 call. I know it's only 12 or 15 cents. It's part of the problem here. Let's go ahead and sell 3 at 15 cents, okay? Well, now what have you done? Now you've guaranteed that the most you can lose on the position is 2.5. You could make 11% if the stock's trading right at $10 on August. Yeah, no premium, Sam. Too low volatility, of course. But, you know, you could get a different risk profile. Notice what's missing from this graph on either end, either to the upside or either to the downside. You can't lose. You're not necessarily near the 8.6 unrealized percent profit you have now. Okay, you're only at 2.5 in this scenario, but you could make 11% if the stock's right at the peak. Now those calls you sold, those 10 strike calls, obligate you to deliver shares of stock. So if it goes up to 1020 or 1030, you may have to deliver your 300 shares of stock at the short call strike price. You've entered into an obligation. You've sold into an obligation. Okay? But at the same time, it would result in an 11% return if the stock was trading right at that price, but you could move these calls. If the stock was trading at 1020 on August 4th, you could pay 20 cents to roll it, move it to a higher strike. There's other things to do as well, but this particular position doesn't have a lot of call premium on it. I could leave the upside open by buying a 12 or an 11 strike call to do another adjustment, what we call income method number 6. What I'm showing you is a radioactive trade after the fact, okay, where you have a gain in the stock and you're trying to lock it in. You don't have to go to January. I showed you the insurance tool where we could look at a variety of different months. I could look at July's, I could look at August or September's, which I'd be able to lock in more profit, but we went out to January and we took the at the money strike, the 10 strike, because that's the most logical to see more profit if we're expecting the stock to move up. You see here, Betty, I could lock in a 5.6% gain guaranteed by buying the 13 put. But that 13 put is so far away from the current stock price relatively that even if the stock moved up to $10 or $12, I'm probably not making more than that 5.6%. I might be better off staying right at the money, buying a 10 strike put a couple months out in time or out to January, to where you have what we call a bulletproof position with no risk. I'm sorry, that's the wrong one. I'm sorry, here we go. With no risk to the downside, guaranteed profit no matter what happens between now and January, and you can still realize further upside, and not great premiums, but maybe every 45 or 60 days, you know, standard August expiration, maybe we can get 20 cents. Ugh, 18 cents. Low volatility is not giving us that much, but I could sell the 2-month out 10 strike call, but who knows what's going to happen in 2 months, right? We could sell that for 18 cents, still about the same. We take that to a guaranteed profit of 2.8, even if the stock's below $5 per share, and we still have about 11% profit that we might be able to make if the stock's trading right at 10. Okay, this is what we call bulletproofing. I can bulletproof if I'm in the position from the beginning and the stock has moved up. You know, if I had originally bought your shares of stock at 876, and let's say I had bought the January 9 strike put at the time for, let's call it $1.10. Okay, so I'm going to have about a 5 or 6% risk on this trade. Sell. I'm sorry, Betty. There we go. Okay, so my original position I might have set up 8.7%. Let's knock that down. It'd probably be less than that. We're going to call this 90. Okay, there we go. All right, 6.8%. Now, as the stock moved up to 950, I may have been able to sell to close my 9 put for January. And this might be getting a little complicated. We could have sold to close this and bought to open the 10 now. And this is still at 63 cents. So let's say today, now it's at 950. I'm going to sell to close my puts for 63 cents. Yep. And I'm going to buy to open the 10s for 115. Now the stock has moved up. So I'm adding an additional debit of about 52 cents into this trade. to get $1 higher payout. Okay, so I'm rolling the put up to a higher strike. I've taken my 6.8% risk down to 1.8, only $54. Now I could sell that July call for maybe, well, not the July, I had to go to 4th of August for 15 cents, collect $45, and I'd only have a risk of 9. So even if I had opened this from the beginning, I could still potentially bulletproof this trade with the 8% movement that we're seeing in the unrealized 8% movement. Okay, so that's what one of the things you could do. You could just sell a call against your shares, but remember what we talked about. If you just sell a near-term call, that's one of the reasons I avoid it. There's no premium. You could sell the 950 for 23 cents, but what does that mean, Betty? That means you've entered into an obligation to deliver your shares of stock at $9.50. I'm sorry, folks. Go back to July 21st, 950 call. You're going to sell 3. All right, so you have 300 shares. You're going to sell 3 for 23 cents. There we go. I'll just refresh this here. Okay. I don't know why that's happening. I apologize. I'm going to try to refresh that chart in a second here. There we go. Let's get out of that. Okay. Okay, so let's try that again, shall we? USO. $8.76. Sorry, Betty. There we go. Okay, and we were talking about the at the money. Would be known as at the money 950. Sell 100. This is just 1 and 1, but should give us the reasonable graph there. All right. Okay. All right, so this would show us about an 11% return on the position, Betty, if you were assigned at 950. What does that mean? It means if the stock went above 950, you would be assigned at $9.50. You'd have to sell your shares of stock. You'd keep the 23 cents, and you'd have an 11% return. I'm sorry, the graphs still aren't showing up. Give me 1 second here, folks. So what's the downside here is that you didn't really protect the downside. If the stock falls now, you keep the 23 cents, but you haven't really locked in any profit. At the same time, you could realize a very high return on the position of 11% if you were assigned, if the stock stays above 950, but that was almost identical to what we had by paying the $1.15 to buy that January put and selling the 10 against it if the stock was trading right at around $10. So one offered a no risk with the potential for 11% return if the stock went up 50 cents. This one offers the opportunity for an 11% return in this situation, 11.4% return if the stock's trading above 950. But if you wanted to stay into it, remember, you'd have to buy back that call or roll it as well. All right, folks. Okay, so that's what the opportunities are that we could do in that situation, okay? My instinct, my preference in this scenario would be to lock in that gain. You can look up the insurance tool to see what's available, but to have a bulletproof position to out to September, October, or January, and you still have the opportunity to generate premium against it, collect dividends against USO if they pay any. I thought they did. Let's take a look here. But think about this. If this was just a straight stock, it's not. It's an ETF, and it doesn't pay a dividend. Okay. But if it's a stock that pays a dividend, you can sit on it with no risk and continue to collect the dividend. Or if it's a standard stock and you're going through earnings, you can go through with absolutely no risk at all. Okay? All right. Okay. Now, other question that you had, Betty, in relation to the options. I think you said July. Let's go to the option chain for USO, and we'll just look at the call chain. I guess in addition to the stock, you've also bought a, July 950 call. Now you said you saw a delta of 0.469 or 496, okay? I'm showing a delta right now of 0.52. What does that mean? Well, the delta is what you'd expect to see in the movement of the stock for a 1-point movement in the stock price. Kind of what we talked to Sheldon about earlier in the presentation. I didn't have a spreadsheet for him or way in the portfolio to see how all of his spreads would change if the stock moved up 1 point. I'm going to talk to the programmers about that. But the delta shows the movement you'd expect to see in the option if the stock moved up 1 point. At the money options, those that are closest to the stock price will always have a delta of 0.50. Calls have a positive delta because they gain in value as the stock moves up. A put option, which we just described, and we talked about for ensuring the position, as well, they have a negative delta. It means they lose money when the stock goes up, but they gain money. I'm sorry, when the stock goes down. All right? Okay, so what does this mean? You have a 950 call. In the next week, if USO moves up to $10.50 per share, moves up 1 point, we would expect the option premium to move from 23 cents to gain 52 cents by the delta. So the new premium we'd expect if the stock was trading at 10.50 would be 75 cents. Okay? The delta is the expected movement of the option for a 1-point movement on the stock. Calls have the positive, and as you go deeper in the money, of course, you get closer to a delta of 1. And you go out of the money, you get a lower delta. So if the stock moved up to 10.50 next week, we might only expect to see this to go up to 8 or 10 cents. 10.50 at the money strike. It might go higher. But the key to remember is delta is ever changing. All right, so once this moves up 1 point, Betty, now that the stock, let's say, was trading at 10.50 at the end of next week, our original 950 call, which had a delta of 0.52, might now have a delta of 0.76. So if the stock USO goes up to 11.50, then next week moves up another point, our option would gain from the 75 cents we had, remember 23 plus the 52, so it's now priced at 75, and if it goes to 11.50, our 950 call would likely be worth about $1.51. We'd gain another 76 cents at that time. Okay? The put option is the reverse, meaning that if I had purchased the 950 put today, there we go, for July, it would have cost me 102. Oh, I'm sorry, it would have cost me about the same, 23 cents. We're looking at the put chain now, 23 cents, and I have a negative delta, okay? Negative 0.48. Right, so what does that mean? This means that if my stock went up to 10.50 next week, okay, well, I'm not going to lose 48 cents because I can't have a negative 20 value, but I'd expect this to go down by half. Okay, this premium would drop to maybe 8 cents, maybe 2 cents. It's going to get closer to 0. You see now, I'm talking about the stocks at 10.50 and I'm holding a 950 put. Okay, so it's another $1 out of the money. Right now the stock's at 9.50 and the 8.50 is a bid of 2 and an ask of 3. It's essentially worthless. That's what I'd expect my 9.50 to go to as well. Now if the stock fell to 8.50, I'd expect this premium to gain 48 cents. So 23 cents plus the 48, my new 950 put would have a value of 71 cents when the stock went down. That is your delta. It is the movement of the stock. I'm sorry, it's the movement of the option premium based on a 1-point movement in a stock. Calls have a positive delta, so 1-point movement positive would gain value on the call, and if the stock fell $1, you'd lose value. On the put, if the stock gains $1, it's going further out of the money, so you'd lose value on the put option. And if the stock falls, the put's going in the money, so it would increase in value. Okay, let me take a, was it a 50% gain I had on mine? Sorry, I've got, okay, all right, so there we go. Oh, okay, Donald says, what about theta decay? Okay, this is also in relation, I don't know when you sent that question, Donald, I apologize. This also goes back to what I was talking about when I was looking at the insurance put. Okay, when I was looking at the insurance. So we went into the insurance for Betty's position, and real quick here, we had USO at a cost basis of $8.76. And I looked at all expirations first. And the stock's at $9.50, right? So let me go ahead and just take July. Now, if I did the at the money, Donald, $9.50 put here, okay, for a price of 29 cents, my time value would roughly be 29 cents. But I only have 28 days to go, so I'm going to lose a penny per day to theta decay with the shorter term insurance. Even though I've got a guaranteed profit of 5% on the position, I'm expect if the stock stays right at 9.50, I'm going to watch this value go down 1 cent per day over the next 28 days. I'm sorry, I'm looking at the July 28th, Donald. My apologies. 24 cents for the 21 July standard expiration, so we'd expect to lose 1.08 cents per day, roughly, over the next 21 days. Now, I'll go to January. Let me hit calculate. We don't have a 9-strike put, but remember that 10-strike put I was looking at is $1.15. Okay, so I'd pay out $1.15, and you say, well, what about theta decay? I'm 203 days out in time. I'm going to lose less than 0.05 cents per day. I don't have the slide, I don't think, available right now, but one of the main reasons in radioactive trading, whenever I'm trying to insure a stock long term, whether I have an unrealized gain or I'm opening it from the beginning, as we saw I probably could have done to take my risk from 6.8% to 1.8, and then maybe bulletproof it with selling a call against it after one move on USO if I'd bought it at 8.76. We talk about the time decay curve of an option. This is 30 days. This is your theta decay in the last 30 days. It's very rapid. Here's 60. So if you sell an option that's 60 days out, you're going to see a rapid time decay. If you buy it, you're going to be on the cusp of that rapid time decay. Okay? And here's 90. Not as rapid, but after about a month or so, you get into that rapid time decay. Here's 120. Here's 150. And over here's 180. If I bought a put that's out to January, I'm going to see very little time decay in the first 3 to 4 months. If this stock stayed right at 9.50, and I paid 115 for this 10-strike put, let's say, Donald, in the next 30, 40, or 50 days, if the stock's trading right at 9.50, this is still probably going to be worth 105 or maybe $1. I'd expect to only lose 10 or 15 cents of time value in the first 60 to 90 days. After that, it's going to be more rapid. Okay, that's the standard time decay curve of any option. We know no stock stays exactly at the same price over time. Okay, we know that doesn't occur. But in general, theta decay is not a concern because it's going to happen more slowly. And as we saw, if my goal is to stay in this position longer because I feel there's more upside, and by August the stock's trading at $10.50 or even $11, this 10-strike put I bought is not going to go to zero. It still has 4 months of time premium left on it. You know, we have September, October, November, and December. Okay, so I have 4 months of time premium left. So it's not going to go to zero, even though the stock's at $10.50. It might be worth 60 cents, 70 cents, so I could sell my stock at $10.50, sell my put for 70, take in $11.20. My cost basis was $9.90. Okay, $9.90. So where am I? I'm at a profit of $1.30, almost twice the unrealized profit I have right now, even though I purchased the put option. Okay, but yes, if I held it all the way to January, it would go. The time value would go to zero. You're right. If it was at $9.50, my option would just go to 50 cents of intrinsic. I'd lose 65 cents of time premium. You're absolutely right. but going further out in time gives you a slower time decay, slower theta decay against the position. Okay? Yeah. Sam mentions time value price per day to calculate, divide by the time value. You get your price per day. That's right. And that's what we do show in some of these, the put time value per month. The January is only 9 cents. Okay? The time value per month for the January option is 9 cents, or what Sam refers to as the price per day. Our July 10 strike, we'll use a 10 strike, okay? July 21 10 strike, put time value is 6 cents per month. Oh, that's the time value, right, because you've got 50 cents intrinsic, my apologies. But that $9.50 at the money is 23 cents per month. Okay, so it's a lot higher, yeah. Okay, so price per day is always lower when you buy further out in time. All right, Jerry says, let's take sort of a similar topic but different. And Jerry says, what are the pluses and minuses of buying a long call, wait for it to show a 25 to 30% gain, and then buy a protective put? How does this gain or loss compare to the married put approach? Okay, number one, oh shoot. My apologies, folks. I thought I just erased everyone's questions and I didn't. Okay, so here's what I'm going to do. I want Nike. This is what I traded today, but for a short-term straddle that resulted in a 56% return. The stock was up 5% or 10%. But let me go to Nike for yesterday. Chain. Okay. And let's go to previous date. Ooh, it was up almost $6. Got out a little bit too early. That's fine. Yesterday was at 53.17. Let's go to August. Let's say yesterday. All right. I'm going to cheat a little bit here, Jerry, but that's all right. Let's say yesterday I bought the Nike August 55 call for $1.17, perfect midpoint. 10 cents bid-ask spread, 5 cent midpoint. I pay $1.17 for it. Okay. Current 55 is at 450. It's too much gain. It's good, but let me just backtrack one. 52.50 is at 665. 230. Okay, maybe the move is too much. The 30% move, but that's okay. Let's just take that example. All right. Let's say that I bought. Let's just take it that I bought it yesterday at 117. Okay. So, why am I doing that? Let me add it to our portfolio. We're going to create a new portfolio here. Charts. No. My apologies. Add to portfolio. I can't do it historically. That's okay. I'm going to leave this page here, and let's go back to the portfolio. My apologies, Jerry. All right, so everyone's saying, why the 55 call? I'm going to show you in a minute. Let's create a new portfolio. We're just going to call it married put versus long call. We're going to have to look at 3 different factors here. So I'm creating a portfolio from scratch. Spelled it wrong, but that's okay. $20,000 starting basis as of yesterday. It's 29. Okay, good stuff. Now, let's go to our portfolio here. Portfolios is where we enter our open positions. Select strategy, long call. Nike, August 55. For price of, I'll keep the math simple, okay? Let's just use one contract. So cost of 112. Now I know you're going to see a 300% return, but we always do this. Okay, so there we go. There's your Nike long call. We're going to look at a put in a moment. Now, let's do a married put yesterday. I would have bought Nike at 53.17 at the close. And so let's go back to our chain. I need the put. My 55 put would have been 282 to 305. Let's call it 20 cents. Let's call it 295. Okay? August 18th. Probably wouldn't have been the put I would have selected, I know, but that's okay. So we're going to put this at 295. All right. There we go. I got to do one more thing. Long stock. Nike. 100. Yesterday, 53.17. All right. Oh, sorry, folks. Here we go. Okay, so naturally we can see the three comparisons. Okay. Your long call is now worth 470. You have a gain of 319.6%, $358 per contract. If I'd opened the married put, stock went up 583 or 11%. My put declined drastically, and I'm at 335. Monetarily, we're close. Naturally, leverage is leverage. Percentage-wise, you win. Okay? Now, what would it be if you added a put to this right now? Well, let's go to the profit and loss chart, and let's say you added a 60 put to your long call. Now, you're going to buy an August 60 with these prices. Let's go to August 18th, and you're going to buy a 60 put for, I'm going to call it 215. Why not? Okay, Jerry? You now have a guaranteed profit of 173. Because of leverage, it comes out to 52.9% or 53% guaranteed profit with more potential for upside and downside as well on the Nike position. So there's your long call. Your monetary gain was 358. The married put showed about the same gain on the position. Percentage-wise, yours looked higher, naturally. Okay? Now, waiting for the stock to add the put, what does that mean? You get a guaranteed profit of 173 on a cost basis of 327. Now, let me go back. I want another tab here for another custom spread, Jerry. Sorry. And let's go back to Nike. Yesterday, 100, 53.17. August 18th. Same price as you. Was it 215, I said? Okay. Now I have a guaranteed profit. There we go. Now I have a guaranteed profit of 468 instead of 173. Now it's only 8.5% leverage, but what am I showing you here? Okay, so what you're looking at is you bought the call first, you've got the gain, you're insuring it with an in-the-money put, you got a 53% guaranteed profit, or $173. If I had just owned the stock and taken that through earnings, then bought the put, I'd have a guaranteed profit of 468, only 8.5%. In the married put I would have been in right now, I have close to the same monetary gain, $335, but what could I do? As we saw before, I could take my August, sell the 55 put, buy the 60. So we're going to sell this for 50. I'll buy this for 215, just as the other three. I have a higher guaranteed profit of $223. Right? I paid a small debit of 160 to gain 5 points with this jump, guaranteed 223. But it's the lie of leverage, isn't it? That's what we're looking at here, okay? Your new straddle has a 52.9% guaranteed profit, or $173. Okay, that's what you have now. You have an in-the-money straddle. Strangle. Sorry, Jerry, Strangle. Okay? $173, but on an investment of $327. Buying the put, if you own the stock and it went up as you expected to $59, buying the 60 put now, you'd lock in $468 of profit on an investment of $55.32. Okay? And then if I'd opened it as a married put first and the stock went up, I'm bulletproof to $223, $50 more monetarily than your Strangle, but again on an investment of $5,700. Okay? All with 1-to-1, all with 100. Where am I going with this? Well, that's the comparison. Okay? You're asking me, and I know this is an extreme gain, but even if you had a $30, 30% or 40% gain, Jerry, you'd expect to see the same thing. The lie of leverage works for you and against you. What is the risk of owning the long call against this. Remember, in your long call, you're risking 100% of what you invested. Now, you probably didn't do one contract. You might have done 5 or 10, whatever, okay? What if the stock had dropped 8%? You'd be at near a 100% loss on your call. You were expecting, you bought the call with this trading plan that it's going to go up 30 to 40% for you, and then you're going to buy a put, and that it would be better because you're using leverage instead of the married put setup. What I just showed you is you'd have more locked-in monetary profit. I know not percentage because that's the way leverage goes. But you'd have more monetary locked-in profit owning the married put first and rolling the put up after that movement, or owning the stock, of course, and then adding the put to it. You'd have 3 times the amount of monetary profit compared to the long call and then adding the put later. But if you were just in the long call and you did trade 10 contracts, and instead of the stock moving from 53 to 59, it moved from 53 to 47 today. It dropped 8% because of poor earnings. You have an investment of $11.20. Your option would only be worth about 7 cents. You've got a loss of 98% of what you invested. I couldn't have lost more than 6.5%. Okay, and I probably wouldn't have even been at the full loss right now, even though I chose a shorter August term option. Okay, so that's the comparison, Jerry. Leverage works for you and against you. Okay, Sam, always following the trades I'm following. Actually, he's not, but he had 50 strike calls in that today. Okay. Bob asks a rough question. I don't know how to answer that, Bob. But, okay, Bob's question here, I've got another big question coming in, but I'm looking at sort of the side shoot questions. Bob said if he could only use one strategy, would it be the married put? Most likely. Why do I say that? I have done some testing this week that I meant to write up for a blog for you guys following up last Friday's webinar. We compared the weekly covered call search to the weekly bull puts. I did my 2 years of testing, and it was phenomenal. The default weekly covered call search we have on PowerOptions, going back over the last 2 years of the testing that we use and the testing tools that we have, was 120% return from June 20th, 2015 to June 23rd, 2017. Then I took our weekly bull puts and I made 2 changes. I increased the probability to 75, I increased the net credit to 20 cents, and I made sure the strike differences were greater than 2 points. I ran that over the same time frame. It was closer to, I think, and I sorted it by probability. I'm sorry, I'm trying to remember the numbers. It was so outrageous. I think it was a 500% return over a 2-year period. I can't beat that with anything, but you know what else, Bob? Why would I still use married puts knowing that over the last 2 years I've seen testing that shows the weekly picks of the day covered call search was 120% return over 2 years, and that weekly bull put that I don't think I can improve any more than those 2 changes I made that got it up to about a 500% return. Why would I still trade married puts? Because that bull put credit spread strategy I mentioned almost went bankrupt twice in the first 3 months. There were significant drawdowns in the covered call one as well. Okay, literally that bull put search up to the 3 iterations of the bull put search. At one point, one of the iterations of sorting it by percent return for bull put credit spreads that still ended up with a 400-500% return was down 68%. That's right. You started with $10,000. It went down to $3,200. None of us would have stayed in that strategy once we saw it drop below $5,000, I bet you. If you had allocated $10,000 to a strategy and in the first 6 months you saw it drop down to $5,000, you probably wouldn't have stayed in. We did. And it was, you know, it paid for itself to stay in, but most people wouldn't do that. There's going to be times when the market changes. So even though I've seen a test result where bull put credit spreads looking for a 75% probability, which means you have a 10-to-1 risk-reward ratio, there's going to be a time in the next 12 months, I guarantee you, where 2 months in a row, you might lose on 10 or 12 bull put credit spreads. You probably would have wiped out 9 months of previous gains. It's not going to continue to be stable and move up. There's going to be something, 1 or 2 corrections over a 10 or 15-day period. I'm not saying tomorrow. I'm not saying August. I'm not saying September. But sometime in the next 8 months. And if you're just doing bull put spreads and that happens, you can wipe out 8 to 9 months of previous trades. Whereas if I'm in a married put, in my portfolio, or 50% of my portfolio, or all of my portfolio is allocated to radioactive trades and married puts, all right? And the market as a whole pulls back 10 or 12%, I'm probably only losing 6 or 7% of my total portfolio. I'm not being doom and gloom. I'm just saying that long term, this strategy, the married put strategy, has performed better in my personal account than long-term use of covered calls, naked puts, bull puts, and more. But I can't compete with the test results I've seen over the last 2 years for the weekly covered call screen, the picks of the day that we have in the covered call, the weekly picks of the day. Ernie's original test over a 1-year was a 42% gain from $100,000 to $142,000. I haven't seen that with my radioactive trades. I took it on for the other year through June 2017, and this went up 120%. The ending amount was $220,000, starting with $100,000 followed Ernie's allocation. I can't guarantee that's going to happen going forward, but it was an extremely successful test. The bull puts were better, but I almost saw it go bankrupt twice. That's the trade-off. So if you told me I could only do one strategy, I don't know. I honestly don't. I want to say married puts, not because I have to, but because I'm trading it with 50% of my account, and I know long-term it could still see 5 to 10% per year. What I'm seeing in these back testings is phenomenal and nothing I expected to see, honestly. I know people have been successful with covered calls and bull puts. I never expected to see them that successful. I'm going to try to do longer term, but I mean, it's just amazing. But in any case, and I meant to finish that blog today. I didn't. It'll be done Monday or Tuesday, and you guys will all be able to see the test results from what I changed on that bull put weekly search that we have as a default and how it turned out. Okay? All right. Betty says, where do I begin? I've been trying to learn option. I see you have so many ways to do them. That's right, but you own stock, Betty, so there's 2 things I want you to focus on right now. Betty had a power outage and came back. Betty, I want you to go to this page because you're trading stock right now. I'm going to send it to everyone. The link is powerop.com/married_put_home.asp. Okay, you have stock position and you have options. I don't want you focusing on these things I'm talking about now as a new options investor. And everyone online would probably agree with me. Sam, who's been talking with us for years on these videos and so forth and through emails and more. Even Bob I've talked to. Bob says, where can you find the article by testing? I haven't posted it yet. I'll let you know when it's posted, Bob. My apologies. Okay, so but what I'm saying here, Betty, is I just sent you the link, powerop.com/married_put_home.asp. I want you to read these 4-part articles because you're trading stock right now. So that means that there's 3 strategies you're really looking at to be simple. Covered call, which we talked about, where you own the stock, you sell a call, it caps the gains, but it leaves the downside open. So that's a covered call. A married put. You buy the stock and you buy a put, so you guarantee up front you can't lose more than 5%, but if an unrealized gain, you can bulletproof it to where you have a guaranteed profit and still can make more to the upside. Combination of the 2 is called a collar. Okay? And that's where I would own stock, I buy a put to ensure the downside, and I sell a call to generate some premium, but it's still a capped gain. Okay, just like a covered call, it's still a capped gain, but I've also added the put so I have a guaranteed profit to the downside. All right, and this means you might be looking to make 3% by risking 4.5 in the worst case scenario. Married put is the most conservative strategy for options traders. I know someone's going to say, well, no, options traders wouldn't trade a married put. An options trader would just trade options and never trade the stock. I understand that. What I'm saying is in combination with anything you can do stock and options, married put is the most conservative, short of doing conversions, which are straight line profit and loss charts, which might guarantee you a 0.01% return, whether the stock moves up or down, and that's not going to match your trading goals, not for a retail investor. For a retail investor, the most conservative combination and realistic for potential profit and protecting your losses is the married put, followed by the collar, okay? Because you're keeping your risks to single-digit percentages. Once you get into buying calls, once you get into bull put spreads, you're taking on leveraged risk, so it looks attractive because you're putting up 1/10 1/20th of the cost you'd have to use to buy the stock to buy the call option. But if the stock falls 5%, you lose 100% of what you invest in the position because the call will go to zero. Okay, that's the lie of leverage. It works both ways. What I want you to do, Betty, is go to that link I sent you, powerop.com/married_put_home.asp. I want you to take a look at this 4-part article that Ernie wrote, the Covered Call Challenge, Limited Risk Solution, and I also want you to read the sketch to start with. After that, call me next week. Send me an email when you go through some of this, and I'll point you to more webinars that compare more of these covered calls and married puts and collars and covered calls to credit spreads, the risks of credit spreads, the benefits of credit spreads, but also the risks. All right. Michael asks, is it reasonable to use options on such a volatile stock as Tesla? Let's say when looking on today's stock price around 362. Oh, yes and no. Sam's online. He already commented in that he was doing his positions on Apple, Tesla, NVIDIA, I believe, as well. He's got some of those, he actually owns some of those stocks, I believe, insured by a put, so he can't lose more than single digits. Let's just take a look here. All right, Tesla. Sam, you can chime in, of course, anytime you want to talk about some of your stories here. Tesla's pretty volatile. The options implied volatility is average, actually, when you get to the at-the-money. But let's go out to July 21. So they're in the 40% range, a little bit higher. I think the average implied volatility on all options right now is around 0.19, 0.21, somewhere in that time frame. Okay, stock's at 360. Okay, so if I bought the at-the-money 360 call, it cost me $1,370 or $1,400 roughly per contract. Is it worth it? Well, it depends on your technical analysis, what you're using options for, and how much of this represents your portfolio. If I'm buying calls on an option, I make sure it doesn't represent more than 2 to 3% of my total portfolio what I invest that call. Why? Because I know it could go to zero. I know very quickly I could lose 100% of what I invested in this call. I don't want that to represent more than 2 or 3% of my total portfolio. So I can take that 100% loss, still have 98% in my portfolio. So even if that means I'm only trading 2 contracts at 2,800, guess what? That means I'm trading 2 contracts for 2,800 because I don't care if I'm really bullish. I don't care what my bullish sentiment is. I'm not putting 10% of my portfolio into a long call or even a long put by itself speculating on a market movement because I could be down 10% in my total portfolio. Okay, where am I going with this? Timing. Timing, strike selection, and more. Sure, Tesla was at 300 a month ago. Oh, sorry, 320, 310, yeah, right, 300 2 months ago, and now it's at 380. What if you're sort of a trend trader, and at this point here you saw Tesla drop below its 20-day moving average, and you saw a negative MACD crossover, and you said, you know what, this is the start of the drop for Tesla. I think it's going to go down to 260. I'm going to buy the 300 puts on May 4th or May 5th. May 4th, May 5th, 300 puts. Now, you're buying them on May, but you probably expected a downturn that was the opposite, where it might go down to 240 instead of going up to 360. Okay? So you maybe bought August options. Let's take a look at our chain. Let's go back in time. I'm going to go back to May. Let's look at around May 4th. Let's look at May 3rd. Tesla's at 311. That looks about right. May 1st, 2nd, 3rd, yeah, 311. Okay? I'm going to go out to August if it's available. It was not, so we're going to go to September. The stock's at 311. The 310 put, jeez. Now we are 4 months out in time. $29, I'm going to call it. Okay? So, I saw that bearish turn. I saw it drop below its 20-day moving average. It was going to lower Bollinger Band. I saw a MACD crossover, and the stock was around 300 maybe the next day. So I went ahead and bought the 310 puts because I was speculating it was going to be at 240. Okay? And we paid $29 for that 310 put, right? $29 for the 310 put. Next day, we're down $2 already, so we lost 10%. Following day, we got a small profit. May 5th, it's a 2050. Looking pretty good there. You know, it's bouncing around, of course, but you're seeing how quickly these things adjust. Now, it's down to 24. I've lost 5 points in 4 days on a $29 investment. Okay, so it's 1/6. I've lost 1/6 of the value on that call, on that put, excuse me, because it's going the wrong way. Where I'm going is eventually here you're down 10. You're down about 45% on May 10th, 7 days after entering it. So does it make sense? Depends on how much you want to watch the market. It depends on how good your fundamental selections are. It depends on how careful you are about not allowing to take too big of a loss. Here's the lie of leverage. Remember when I showed my married puts and I showed that if I opened a position, let's say on Tesla at that time, I might have only had a risk of 6%, and that would be out to January. Well, let's say the stock fell. Let's say it fell 20% because I was bullish. Well, I still might be at a loss of 5.3% on the position, but you know what? Even if I close for a loss of 5.3%, or let's say 5%, I'm sorry, you know what I need to get back to break even with a loss of 5%? I just need a gain of 5.3% of what I have left invested. Here, Tesla, in 7 days, your put, your 310 put has dropped 10 points on a $29 investment. Okay, so you're roughly down about 33% on that position. You know what you need to make if you have a 33% loss on a position? Your next position has to have a 50% gain to get back to break even. And if you take a 50% loss, which can quickly happen with long calls and the leverage, okay, you need a 100% gain on your next trade to get back to break even. This is the lie of leverage in action. Okay, so does it make sense to trade bull put credit spreads, buy calls, buy puts, do those things? Sure. Sam's got married puts on Tesla. He's also doing adjustments in between of selling calls as a covered call, rolling. He says he only sells calls on a sellout like QQQ. Tesla, he's got a spread on right now. It's a July call. It's 435, 430. He's in a bull call debit spread. He really hates selling calls. I do too because it caps the gain. Everyone thinks it's a great strategy, especially for the married put. That's the first thing you got to do is sell a call to lower the risk. Well, you cap your upside. If the stock goes up as you expected, you miss that opportunity. You've got to pay more money in to buy it out. So does it make sense? Yes. I've seen successful spreads on Baidu, Nvidia, Tesla, Amazon, and more. And Amazon's not that volatile, believe it or not. Okay, but that's the idea as well. Okay, is that anytime you're talking, Michael, about just using calls or puts, you've got to be right more often than you're wrong in order to profit long term. Okay, there are investors out there who teach cheap, out of the money, long call and long put purchases. So on Tesla today, you know, they might only, no, let's not take Tesla. Let's go ahead and take Apple, okay? We'll look out a few months on Apple instead of Tesla. But what they do is they say, okay, well, we want to appease the masses, all right? They've got a structure together where they want to appease the masses. And, right, August, yeah. Oh, let me go to current prices, guys. I'm sorry, ladies and gentlemen, my apologies here. Let's go to current prices here for Apple. Fantastic. And I'm out in September. That's fantastic. Okay, so they're looking at this chain. I'm going to go to medium chain for us, and they'll say, okay, well, what we're going to do is we're going to buy the 160 calls 77 days out on Apple for $1.15. Hell, they might buy the 170s for 37 cents to keep it cheap. Now, they would say, you know, if the stock moves up 20%, let's say even 10%, you might see a 300% return. What does that mean? If the stock goes up 10%, $14 to 158, this option might be worth 95 cents. You paid 37, it's at 95. Okay, well, how much are you going to invest in it, number one? And if it doesn't move and it goes the other way, you lose 100% of what you invested. The guys that are doing this expect and plan for only being right 18% of the time. They're wrong, and they expect to be wrong 72% of the time. Their hope is that some of these will turn into 300, 400, 500% gains. So my 30-cent deep out of the money option would go to 150. It's a 500% gain. Okay, but that would counter 5 losses they took that never met there. that went to zero and they took the full 100% loss. This isn't a common approach, and I don't think it's more successful than doing at the money or slightly in the money covered calls, to tell you the truth. The return there is that as well, okay? All right, and that's kind of the key. Rajiv says there's a bullish call on NTNX as a married put will be a better option, but issue is with the bid-ask spread on the option selection. Yeah, I mean, you're comparing sort of an out-of-the-money call to an in-the-money put option. The in-the-money put option might have a wider bid-ask spread to look at the parity trade of buying the out-of-the-money call. But NTNX, you know, you're comparing single digits versus full leveraged, okay? Okay. And that's the other issue as well. All right, Donald has a question. I got to answer this in 3 ways, and I'll get back to NTNX if I have the time in just a moment. Okay, so Donald's question says, how do you backtest? Okay, we have 3 ways of backtesting, essentially. Now, you just saw me use the historical option chain, Donald. I pulled up Tesla. We went back into May. I looked at all the options prices, and then I could run through day by day to see how they changed, manually jotting down what was my price. Long call. I'm going to go, I'm going to go into our backtesting tool here on the trial. This goes back, our backtesting data goes back to April 2006. Okay, but we're just going to use it here on the trial. It only goes back 3 months. So I'm going to select one of my, go back to May 3rd. And we're going to use our Bollinger Band default screen on PowerOptions, but if you save your own search criteria in the search, you know, I've got, okay, I'll use my long calls. All right. So I'll go ahead and submit the search. Now, this is going to take a little bit. I apologize. It does every Friday because we're actually uploading the new data for today after the market closed. So we're transferring 4 gigs of data, I think, per day. I believe that's what Greg told me the other day, about 4 gigs of data for all the options. All right, I don't have mine selecting, Donald, to look at only 1 result per security. So I have 3 potential results for Costco, 3 for Coach that matched my criteria. So I set in some stock and some option criteria. You can see that over on the side. These are the long calls, the top 15 long calls by my sort results for percent current option volume that would have matched my search on May 3rd. Okay, so now I can say, well, calculate group results. Some of them have different expirations. It doesn't matter. Okay, and I see here that of those positions, 8 out of 15 were successful, only 53% from May 3rd to today, but it's a 37% gain because, as I mentioned, some of these, especially CNI and ECL, 300 to 230% profit, paid 50 cents, and it moved up to $2. That's a 300% profit. Paid $1 at 330, that's a 230% profit. Here's a couple other hundreds, but 1, 2, and more, it looks like 3 had 100% loss, 99% loss. Okay, that's what I expect, all right? 53% of the time I was right, had some big winners, had some 100% losers, but it did turn out that this would have been a profitable search. Now, manually what we have here is that you can do that over time, meaning that you can, I'm sorry, I could go back further if I had the historical, Donald, and I could run this search each and every time and see, you know, what was my return monetarily for this 2 months, then the next 2 months, and so on and so forth. You could do that. Now, we have another tool that you can use. Just ignore this for a moment. I'm going to go to products here. Strategy testing and optimization. And the strategy testing service, what this allows you to do is that if you have a saved search criteria, and even if you have some ideas for stops you want to lose, if the stock is below the put strike price or below your call strike price, the stock dropped 10%, you'd stop out of a position, whether it's a long call or it's a long put. In the background, we've developed a tool that does this more manually for us, or more for us, okay? And so what you can do here is $50 to run a search, and this is what I did with the bull put screen. And hold on, everyone, for a moment. Let me take a look here. Is this it? Give me 1 second, folks. All right, I'm just going to go ahead and show it. I don't know if this is the right one. I saved all the results. This is what my test results looked like. I know it's hard to understand, but for the bull put test, and that I haven't written up yet, but I've got the data. I've got something else to show you. Okay, weekly bull puts. This is the weekly bull put spread we talked about last week, default search. And I went from 6/20/2015 to 17, 24 months. I started with $10,000, which would only represent 10% of my portfolio if I had $100,000. That's all I'd allocate to spreads. But of that 10,000, I'm going to allocate 33% to each trade. Okay, so I'm going to put $3,300 in each trade, and I'm going to open every Monday. And you see here at 6/22/2015, we opened 3 positions on Baidu, PanW, BIB, and then it shows me what happens on expiration of July 2nd. And you can see here, PanW is 100% loss. Baidu was 100%. Right off the bat, I'm down 60%. Because I did take that 10,000, I allocated 33. 2 of them were the full loss, so I'm down 60%. Okay, but make some back, and what it's showing me is each iteration of finding new positions on Monday that were 14 days out in time for my weekly bull puts, and at the end result, I don't know if you guys can see this if it's too small, but the end result, this cash on hand was $56,021, 460% return, 118 wins and 22 losses, 84% win ratio. I showed this to Ernie, and then we tested that as well. And what I mean by that is that when I put in a ratio of making 20.2% when we're right and losing 63.8% when we're wrong, the minute this percentage win ratio drops below 79%, you start to lose money. The window is that small. This one just happened with the criteria I was using. It happened to have an 84% success rate. I did better than this. I did one change to this search that I created because I didn't think there's any way over a 2-year period with 140 trades I'd see better than 460. I improved it by about 100%, up to about 540, by changing one simple thing. And that one simple thing was changing the sort from percentage return of highest to lowest to percentage probability. That took it up to about a 540% gain over the exact same time frame, but taking the top 3 with the highest probability instead of taking the 3 with the highest return that matched my search. There were only 9 losses and a 94% success rate. It was amazing. But the average win was only 8% instead of 20. It's amazing how that trade-off can go. But this is the tool that we use when we run those searches. When you provide your criteria to us, it's $50. We run it, and there's an upgrade to that that's actually about $500. Well, we'll work to improve your search if you don't think it matches what you'd seen. Okay? But that's our back testing, Donald. That's how we use it as well. Okay. I'm sorry, Betty asked a question. I don't know if she was with us at the very beginning of the presentation. Hold on, Betty. Let me go back here real quick. Bouncing. I've got too many windows open. You know how that goes. All right, 1 second. Here we go. Okay. Let's go back. Okay. Betty, I'm sorry. My name is Mike Chupka. I'm the Director of Education here at PowerOptions. And as I mentioned, PowerOptions is a patented suite of search and analysis tools. Ernie Zarrender created the PowerOptions tools in 1997. I've been with PowerOptions since 2001, so for about 16 years. I've traded covered calls for 18 to 20 months, and I stopped trading that. It was all I was allowed to trade when I first started, but I wasn't getting ahead with the covered call strategy. So I looked at naked puts, I did collars, diagonal spreads. I've traded almost everything except for iron butterflies, short straddles, short strangles. I know the strategies involved and the risks and the rewards. I've taught across the country. I've taught at the Options Express Expo, back in 2007, 2006, I believe it was. And I've done for the now disbanded Atlanta Options groups. I taught 2 seminars there over the years as well. Taught for groups in South Carolina. I do about 3 to 4 webinars a week sometimes. I've narrowed that down to about 3 a week really between PowerOptions and RadioActive trading, and sometimes with other services as well as a guest speaker. So background as far as that's my trading background. I went to school for geology and micropaleontology. It just so happens that Ernie Zarrender, his son Greg, who started the company with him, was one of my friends from high school. When I was looking into grad school here back at University of Delaware where I grew up, they were looking for people to help out with customer service and writing technical articles and things like that. And that's what I started to get into back in 2001 when I was kind of between classes at grad school and things of that nature, and then became lucrative, and I enjoy what I do. So that's me in a nutshell. And I'm here every week, Friday at 4:30 till sometimes around 6 o'clock as we are today, and then of course during the week on Wednesdays and Thursdays for RadioActive trading presentations and Power Options presentations as well. But yeah, those tools on Power Options, they've grown over the years based on customer feedback, new resources available, as you kind of mentioned, for weekly options and things of that nature. New strategies that have come out, new ideas. We go through all of that as well. All right. Well, it is about 6 o'clock. I don't think I'm going to have, don't see any other questions here. What I wanted to show you, of course, that if you haven't done so yet, remember you can go to Power Options and just put in your first name, last name, and email address, and you'll be able to get the 14-day free trial. Then after that, our services range from $40 subscription fee for just the end-of-day data at the lower tier. Most common is the 20-minute delayed service on the data, which is $60 per month. We do offer the real-time, of course. And the addition of the historical is $40 beyond that as well. If you want other resources, Betty, over the weekend, remember you can go to our blog, blog.powerop.com, but check out those links I sent you under the Married Put tab there, Married Put Home, the 4-part article that Ernie wrote, the Covered Call Challenge, Limited Risk Solution, and Finding Married Puts and Collars, and check out the sketch, give you some introduction on a way to trade with your trading stock, but with very limited risk, so you're controlling that risk rather than accidentally buying 10 contracts of a long call and too late realizing you were risking 100% of what you invested in those long calls or those long puts because you fell into the trap of leverage. Okay, that's not what we want to see you do. We want to get you to a point where you're comfortable knowing that you can lose 100% if you buy calls, how to pick the right calls or puts potentially to do a trade, or maybe a straddle or a strangle so you can maybe profit if the stock goes in the direction you want or the other direction. More of an earnings play, really. But to make sure that you're not risking more than a certain percentage of your portfolio with these leverage trades, because you could lose 100%. That's always got to be on your mind, okay? But that's our goal here, is to educate the strategies, point out the risks, and if the risks don't match what you want, we can find a more conservative strategy. You can also check us out on YouTube. We've got tons of videos on YouTube. They're also the ones that are archived on our webinars page we looked at earlier as well. But you can just go to YouTube, search Power Options. You'll see last week's open discussion. I'll have this one posted later on tomorrow, most likely as well. Again, remember everyone, if you need to contact us or you think of a question later on, go ahead and send me an email at any time to support@powerop.com. Your questions about RadioActive, you can send me an email to support@radioactivetrading.com. Remember, you can also call the market during office hours. Okay, Sam says, a lot of thanks again. Have a relaxing week and spend time with the family. Come back on Monday with fresh there. Absolutely. Okay. Okay, and Rajiv points something out too. This is kind of what I mentioned about the picks of the day for the covered calls. There's also weekly picks of the day for the naked puts. And, you know, that search that I told you guys about that I'm going to post in the blog as well eventually and let you know the comparison of the two, that is going to become the weekly bull put picks of the day. But Rajiv points something out. He says, on the monthly put naked picks of the day, NVIDIA popped up. But the current market condition against semiconductors, and I'll admit I'm not taking a bath because I'm have a bulletproof position on AEIS, but it's the same in NVIDIA. It's dropped from $85 to $67 per share just in the last 3 weeks. I wasn't fast enough to buy another put on it to convert it to sort of a strangle position. But anyway, Rajiv's point is that on this naked put picks today that Ernie shows up, the current market condition is against semis. He did fundamentals, and it's not part of the recommendation. Yeah, it did match the recommendations. It did match the criteria the NVIDIA one did, Rajiv. And again, if that's not something you're comfortable trading, that's fine. You know, we're just posting the results based on what we saw over that 1-year test period that Ernie did. I haven't done the naked puts picks of the day on the 2-year test period I just did. I'll probably do that on Monday or maybe Wednesday, okay, after we get the blog up of the covered calls versus bull puts to satisfy that. But yeah, if it came up in that search, either at one point this morning when it was run at about 11 o'clock this morning, it would have matched that criteria. It might not have at the end of the day, you know, because that picks of the day only updates once a day. What you want to do, Rajiv, is instead of going into the picks of the day screen, go to naked puts and go to the search. One of the default searches is the weekly naked puts today, so that will show you the 10 ones that match at that time, not based on the one time a day that the that the picks of the day were updated. You can go into the search and see the weekly bull puts, and it'll show you, instead of just the top 3 that's shown in that picks of the day format, you could see the 10, 15, or maybe 20 that match the other criteria, not just the top 3. Okay, so you can do that at any time. The picks of the day screens for monthly and weekly are available in the standard search for covered calls and naked puts also. So you can interact with it more than just seeing the top 3. So you want to check that out. All right. Well, thank you everyone for your questions. Betty, I'm sorry if your head was spinning a little bit after the information that we talked about today, but I hope we've got you on a good path to get going. Sam, thank you, and I hope you have a fantastic weekend also. And Donald, I hope you saw some usefulness with the back testing, and if you have other questions about it, give me a call or send me an email at any time as well. As I mentioned, I'll convert this webinar soon and likely post it tomorrow or Sunday, and we'll send an email when this webinar is posted. I'll probably send you an email Monday when that blog is posted before the shortened market day ends at 1 o'clock Eastern Time. Take care, everyone. Have a great weekend. Have a fantastic 4th of July Independence Day if I don't see you before then, which I might not. I'll see you, of course, meeting online. And let's get ready for a short trading week and have some fun. See you all soon. Good night.